Hello and welcome back to another episode of Wealthy Expat. This week I've got Liam Rogan on the show from GetGround in the UK. Liam, it's great to have you here. Thank you for joining me.
It's a pleasure. Thank you so much for the introduction, Chris. It's great to be doing more of these things again. But we basically spent a year and a half only doing these, and the minute people could kind of see each other again, everything went back in person. So I kind of miss doing these, and they're a bit more relaxed and kind of in person. Thanks for having me.
No, it's great to have you here. And like you're saying, it's a strange reality we live in now. It's when you invited me last week to come into the office, I was thinking, I haven't done that in 12, 18 months now. What is that?
It feels offensive when somebody asks, and you're actually, no, that's
it makes sense now. But it's great to have you here nonetheless. And I'm looking forward to digging into a number of topics with you, understanding how GetGround works, how the business was kind of founded and what its aim is in terms of helping clients around the buy-to-let investment world, and digging into your predictions and what you're seeing in the market at the moment from a investment standpoint. So I think it's going to be a good conversation. But to start off with, maybe it's good to start with a general roundup of what you've been seeing over the last 12 to 18 months, you could say, since the course of the pandemic, in a sense, but understand what you've seen in terms of the buy-to-let market and how it has responded, and how your product, the offering that GetGround has been received in the market really as well. So it'd be good to hear that perspective to start off with.
Yeah, so it's been a wacky year and a half, is the truth. So I mean, obviously COVID was kind of a once in a lifetime, if not generational, occurrence, and nobody really knew how it would affect markets, be they your typical financial market, stocks and shares versus property. And there was a lot of fear around it, and obviously with the nature of our business, we were kind of worried about how that would affect us, and we actually didn't need to worry. Things actually went well for us as a business, went tremendously well, but for the real estate market as a whole went pretty damn well, truth be told. Reason being, at least from our perspective, is in times of panic. I mean, you had that kind of first month where everything was hitting, where yes, everything kind of shut up and closed down a bit, but off the back of that, you had your traditional financial investments, stocks, shares, bonds, and things like that plummet 30% overnight.
Yeah.
And so people, I think, in times of fear and in times of uncertainty, go to much more tangible assets, which is what property is. No matter if there's a war on, or if there's a virus, or if there's some economic crash anywhere in the world, property is always a very strong, tangible asset. It's very hard for a property to lose 30, 40% of value overnight.
Agree.
And typically property prices at worst stagnate. It's relatively rare they actually depreciate. And so I think a lot of people were pulling funds out from their traditional investments and putting them into property. UK property as a whole has always been seen as a safe haven for the world. It's why there is so much foreign investment in the UK. It's always been a safe place to put your money. It will, always grow to some degree or another. The returns in terms of a yield perspective are pretty great too. And that's exactly what we saw. After that kind of first month blip between sort of March and sort of mid to end of April, everything picked up from then. We work with about sort of 200 or 300 real estate partners around the world as well, and they saw the exact same thing. Things picked up again. People who, I think the pandemic gave people a lot more time to get educated on investing, and be it with cryptos and things that are all the range. Also property. I mean, there's so much great property related content from an educational perspective out there on YouTube and everything else. And when people have nothing to do and they realize, well, I've got 100K sat in my bank account, it's not doing anything. Well, now's the time to learn how to do that. I think there's a big uptake in that. I know a lot of property education companies saw the same. And so, the market's been flying. The SDLT holiday obviously helped things as well.
I was going to say,
And so September was a big month, with lots of completions in there. Admittedly, things have gone slightly quieter now, but I think that's only because there was a natural sort of rise during that period. But it's been a busy period, and with a busy market, it was busy for us as well. So we've had huge volumes of clientele through. I forget the actual growth metrics, but I think we did not far off 10% of the market share for company creation last month, for companies related to property investing. So it wasn't far off 10% there. And I mean, in that period as well, with people getting more and more educated around property investing, even those who already have properties, the understanding of limited company structures and how best to structure investments became a big focal point of many investors' lives. I think that's why there's been an even more increased usage of company structures during that period. And obviously that's been good business for us. And the market as a whole has changed massively. So in 2015 or so, about 15% of buy-to-let purchases were made in limited companies. Last year, that was 60%. So that across that 5 or 6 years period, that's grown, from 15 to 60% of the entire market, which is massive. So it's been an interesting year and a half for sure.
Definitely keeping you busy by the sounds of it. That's some impressive numbers though from a growth standpoint. And I guess, like you said, though, people have had time to now educate and understand how they should structure these investments of theirs. And we'll dig into it in a bit. But I think having that limited company and people see the opportunity it presents from a stamp duty, land tax perspective, and many other benefits that we'll dig into, I guess, later on. But that's interesting. It's an impressive thing to know. And I think to start off with as well, the next question would be around, what is GetGrand? Who are GetGrand? Let's give our audience a bit of an understanding of what you do and how it actually works before we dig in, I guess, too much into the limited companies. But yeah, who is GetGrand? Let's say.
Well, what is GetGrand? Is a very good question. So first and foremost, we're essentially a property technology company, and we're aiming to do two things. We're aiming to, first of all, educate investors on how to structure their investments. So do a real deep dive into their situation, help them figure out what is the best route to actually go. Because lots of people, especially starting off in property, will fly into property investing and think, okay, well, I'll buy this property and I'll get a mortgage and that's everything. And they'll be promised, a great yield of 7 or 8% and then great returns over the years. But the reality is that those yields and those rental returns aren't real until they're in your account in cold hard cash. And so the aim of the game is, well, okay, which structure allows me to, get as much out of this investment as possible, and how can I protect myself in the meantime and access as much value from this investment as possible? And that's something people don't give a massive amount of thought to, or can be very confused by. So what we try and do is educate people around limited companies, help them understand the ins and outs of them, remove all the tax jargon and everything else like that for them, and help them figure out if that's the route for them. If that is the route for them, we've basically created this technology-based solution for people to take that route, whereby we've created the GetGrand platform where people can set up and structure their company on it. We do very high caliber structuring of those companies to make sure they're purposely built for buy-to-let investments, so they're structured to make them as tax efficient as possible and everything else like that. We coordinate with all the players involved in that. So, be the mortgage brokers or the property agent or the solicitors, keep everybody in the mix and help things go very smoothly and efficiently. We also set up the company's business account. So companies in the UK, especially if they're getting a mortgage, need a business account, need a business bank account. These can traditionally be very, very difficult to get, especially for those based overseas. We've managed to create a very streamlined, very easy process, which we can open one of those automatically for clients. And then beyond that, we look after everything to do with the company. So we look after the entirety of the financial administration of that company. So that's everything from the corporate tax returns, the bookkeeping, the registered office, secretarial work. We'll even act as a process agent if the client wants us to. And so trying to basically create a tech solution to bring all that under one roof and do it very, very cost effectively. So the issue in the past was that, as well as it being a hassle to go the limited company route and confusing, it was also very expensive. So your typical kind of cost to go the limited company route for services similar to ours, you're looking kind of £1,700–1,800 a year.
Wow.
Now, if you're doing that on your first property, that's a huge amount of your rental income spent purely on just facilitating this company. To mitigate that and make sure that investors from the outset can own in the corporate structure and receive the benefits from that, we have a very cost-effective pricing structure, which is essentially where we charge £20 a month to run the company. So you go from this huge, £1,500 plus cost per year down to £20 a month, which kind of makes it effective there. And so that's kind of
Sure. Sorry. I was going to say, would you say there's an average sort of saving figure that you have in mind per client at the moment, or does it really vary depending on the situation?
It varies because you'll have people who come to you and say, oh, well, my accountant Bob round the corner says he'll do it for, £900 a year, which, okay, still, 3 or 4 times more expensive than we will. But, he'll do it for £800 or £900 a year. Okay, well, the reality is, it's a bit like mortgage interest rates. Like when people see something advertised, they don't realize that is usually the base offering. Yeah. The minute you start asking your accountant questions, that's a charge. Whenever you want this extra thing, that's a charge. I spoke to the guy the other day, and I'm really confused because my accountant said it'd be £800 and I've just been billed for £1,900. I'm like, well, exactly. He showed me the list of everything. I was like, well, yeah, exactly. So So
Makes
it's
sense.
hard to put that kind of typical saving on it, but it's considerable is the point.
Okay.
And so we're just trying to make it accessible for everyone, because the issue with property as a whole, as an asset class, it's really archaic. It's really old school. It's really backwards in some ways. And so, if you think how long it takes to purchase a property, quite often, it can be really off-putting for people, because you've got to speak to 6 different people, a mortgage broker, the lender directly, the property agent, the solicitors, everything. Conveyancing can take months and months and months. Exchange, completion, all of that can be off-putting, and property is quite slow for that. Whereas your other financial markets, stocks and shares and things like that, are much, much more efficient. So what we're trying to do is be part of or a cog in the property market, which allows it to run a bit more efficiently, so that more people can get involved and not be put off by it, and make things a lot simpler and cost effective for them.
That sounds great. It sounds great. Where would you say most of your clients are coming from at the moment? Is it locally or domestically, or internationally?
It's a real mix. So I think on the actual platform now, in terms of users that we've got on the GetGround platform, I think we're over 6,000 now. And so if I was to put a figure on it, I'd say maybe 60% are UK based, and then 40% are based overseas. So we have a massive overseas investment base. We also have physical operations overseas as well. So I'm based out of our London office in West London here, but we've also got an office in Hammersmith, an office in Hong Kong, and an office in Singapore as well. And we'll likely have more in the future as well. So probably 60-40 UK to international. In terms of international, where are we seeing clients from? Lots of your traditional hotspots, the UAE, Saudi Arabia, Hong Kong, Singapore, etc. But we also see them from potentially newer markets or growing markets. So we get quite a lot out of Africa, so South Africa and Nigeria and places like that.
Interesting.
Kind of Gulf states. We have a lot of Australia, which I know obviously you have a big connection to. We do there's a lot of British expats out there, but also Australian citizens themselves looking to invest in the UK.
Interesting.
America's growing as well. So yes, it's a real mixed bag.
That's interesting. Okay, that's good to know. And from the countries you just mentioned, are they mainly British expats looking to invest back home, or is it foreign nationals, or a bit of, the numbers could vary again, a bit of a mix?
Yeah, interesting. You would think it would be expats. I would actually say it's probably also foreign nationals. So yes, we do definitely have an expat cohort who invest. But I would say, from my experience at least, most of the internationals we have are foreign nationals. Some may have, children studying in the UK. That's quite a common one, where they'll kind of invest while the kids are here, type of thing. I would say generally foreign nationals. Yeah.
Good to know. I guess it just goes to show the power of the UK property market from an international perspective.
And especially if you look how kind of crazy the world can be, especially places like Hong Kong, for example, how crazy things were in Hong Kong for quite some time, and everybody's trying to get out of Hong Kong and take their money offshore. And it's the same with Africa and places like that, trying to divest away from. We see that a lot with South Africans. They're trying to divest their money away from the rand, because the rand's been struggling so much recently. Invest in a much stronger currency, the pound. And so yes, that's been a very common theme.
Okay, that's good to know. Well, yeah, some good points, a good background into who GetGround are. And now, if we could run through a bit of a scenario from how the process works. If let's say I was going to purchase a £200,000 apartment in Birmingham, for example, what would the process be for me if I approached you and said, let's open a company account and purchase it within a limited company, run through that process. But would you mind giving us a bit of a run through, a bit of a background?
What I would say probably as a starter point is the much more common scenario we have is, so we're almost an entirely referrals-based business. So the 200 or 300 partners we have around the world will have clients who are investing with them. And they'll be looking at, say, some units in Birmingham, as you say, £200,000 unit. And they'll have heard of limited companies or various other vehicles to structure their investment, but they might not know a lot. And they'll ask the agents, hey, can you tell me more about this, or should I use a company or not, or should I use this, etc. And obviously those agents aren't qualified or already in the know of how to do that. And so they'll then refer them on to us. Our team of consultants here will have basically as many consultations with the clients as needed, all free of charge, to help them figure out what's the best route for them. So dig into their own kind of personal circumstances and basically give them enough education that allows them to decide on which route they want to take. And sometimes limited companies aren't the best way to go, and we will very often tell people that. But by and large, actually, for most people, there are either all of the advantages or some of the advantages that apply and very worthwhile pursuing. And so most people do end up going down that route. I mean, like I say, 60% plus of buy-to-let purchases in the whole of the UK last year were made in companies. This year, I would imagine that's probably even close to 70, if not beyond. And so what will happen is they'll be referred over. They'll have as many consultations as possible, take them through some audited investment examples so they can kind of see how a cash flow might look in relation to themselves. And then if they are keen to go ahead, they've got two options. So they can either go ahead onto the platform themselves and set it up. So the GetGround platform is accessible around the world. It's really easy to do. It's very, very simple. And they can onboard themselves there, or they can onboard and design their company with a GetGround consultant. So some people who are a little less sure or just want a bit more kind of clarity going forwards, instead of a Zoom meeting, the person will guide them through it as they do it and get their company set up on there. And in terms of the actual process, they only really need a copy of their passport, a copy of their proof of address. A selfie is taken on the platform for facial recognition purposes, and then details of the property they're buying. So realistically, end to end, you're talking sort of 15 to 20 minutes.
Oh, wow. That's an impressive turnaround. That's a very impressive turnaround.
Very
yeah. And would you say, so you mentioned a point there about it not fitting all, essentially, and not a one-fit-all product. So would you say that it's more appealing to people who are higher earners, for example, or people that have a portfolio of their own at the moment, or if it's your first investment, if it was your first investment, would you suggest purchasing it in a company, or what are some ideas around that?
It's really hard to gauge. I would say that there's, by and large, relatively few people who aren't going to benefit from it in one way or another. There's certain situations where you'll have somebody who has very, very little income in total, and they don't have any children, and they're not looking to use a mortgage, and they might have saved up 50,000 and they've got a very low sort of total income in general. Possibly in that situation, it's not necessarily the best route for them. But by and large, for most property investors, it is. And there's different facets to look at. So a lot of people, there's so many misconceptions about company ownership. It's why we consider ourselves an educational entity, is because it's so hard to get detailed information on kind of the ins and outs on this without paying extortionate amounts of money, sometimes unnecessarily, to find this out. And so, people who are aware of company structuring are aware of the big sort of notable benefit that happened in 2015, which is that you can deduct your entire mortgage interest costs from your tax bill, which is a huge benefit. But people who aren't using mortgages are like, well, that doesn't apply to me, so this isn't relevant. Well, actually, that one might be, but these are, lower capital gains tax on the sale of shares. The incoming buyer doesn't pay stamp duty, land tax. If you're purchasing the property via way of the shares, you're paying corporation tax rather than income tax. You can protect your first-time buyer's allowance. You can mitigate inheritance tax for your kids. If you're overseas, it's usually easier to get a limited company mortgage than it is to get a personal loan mortgage. Things like that. And especially in the case when people say, "Oh, I'm not using mortgages," often people aren't aware of the sheer power of leverage and how useful it is to kind of maximize what you can actually do with your money. And so what we say to people is, okay, well, that's great, but when you realize about leveraging in 6 months, a year, or whatever, you'll probably want to refinance, which is
come
fine.
back. Exactly.
But it's too late at that point to economically put that property into a company. So it's like, okay, well, keep it in there for now, and when you finance in the future and you get a limited company mortgage on it, you can reap the benefits of that then. So I'd say, but by and large, most investors in one way or another benefit from it. But it's their decision at the end of the day. And so we'll present a very transparent take on it to them. If they don't see any value in it, then that's fine. They don't see any value in it. But the vast majority of people do.
Okay, that's interesting. I think that's a good point. And you made a point in there about the first home buyers as well. So did you say, what was your point there? If you could go back to that as well, was it saying that you're still eligible for your first home buyers?
So a common use of limited companies in the UK is people often use them to protect their first time buyer's allowance. So that in the future, when they come to purchase a property, they can benefit from that allowance and paying a lower rate of stamp duty. So if you're buying, a £700,000 property in 4 years, but you're going to buy an investment property now, it may make sense to put that initial property into a limited company, because it means that when you come to purchase your future one, you don't already have one in your personal name. and you don't have to pay the high rates of SDLT.
That makes sense. And how many companies could you put? Sorry, how many properties? Sorry, could you put inside a company? Is it one property per one company, or can you build an empire, property empire in it?
Yeah, so legally you can put as many as you want in a company. That's not a problem. But something we do quite uniquely on the platform is we actually put an SPV or a company. So an SPV is a special purpose vehicle. It's basically a company that's been built specifically for this one purpose, which is to buy and hold this investment property. We actually wrap one of those around each property on the platform. Now, when people get told that, sometimes it can be a bit shocking because everybody just assumes, oh, you set up, one property holding company, you put everything in that, and you reap the benefits there. But the truth is, we've done an awful lot of legal and financial research into this to figure out basically, well, what's the best way to extrapolate as many benefits from company ownership as possible? And actually, the best way to own is in separate entities.
Okay.
And people can be taken aback by that when they say it. And so what I say is that it's a bit of a cheesy question, but well, why would you hold them all in the same company? And people go, oh well, I don't know. I suppose it's easier, isn't it? Or it's cheaper, isn't it? Or something like that. Yeah. And the reality is, because we've made the platform the way it is, it's no harder to own them in separate entities on the GetGround platform, or any more expensive to hold them in that platform than it is to hold them all in one with another. And the reason we do it, without going into too much additional detail, is one of the biggest benefits of company ownership is that when you come to sell the property, you can either sell the property from the company, or you can sell the property by selling the company's shares. Now, when you sell the property via way of the company's shares, you're still selling the property. Yeah. It's just that it now has this wrapper around it, and that wrapper is the company's shares. And when you sell that way, you listed two pretty substantial benefits. The first is that the buyer doesn't pay stamp duty land tax on the purchase of that property. So you as the seller have a price advantage. So if you're selling a property which has, would normally incur the buyer £30,000 of stamp duty land tax, they're no longer paying that. And so you as the seller can increase the sale price of your property by, say, £20,000. And the buyer's actually still happy to purchase at that price because they were going to purchase that property anyway, except now they're making a £10,000 saving. You, on the other hand, have increased your capital gain by £20,000. So both buyer and seller have benefited. And the secondary benefit of that is you pay substantially lower capital gains tax on the sale of shares than you do on the sale of property. So even though technically speaking, you are selling the property, officially speaking, you're selling the shares. And so when you exit the investment, you're basically driving up your capital gain by an extra 20 grand, but you're also simultaneously decreasing any capital gains tax liability for it. Now, the issue is, when those properties are in the same company, you can't sell one property by selling the company's shares, because you're obviously gifting away value in all of those assets there. If you put them in separate entities, you can. You're just selling that SPV on. It's really, really simple. The platform is designed for that, so you can sell them to any investor really easily. Okay. The secondary reason we do that is from a protection and liability perspective. So one of the big reasons people use companies in general is to limit their personal liability. When each property is in its separate entity, you don't just protect your personal liability, but you protect your portfolios. So if you've created a company that's got 7 properties in, and they're all mortgaged under that, one thing happens to one property, your whole portfolio is at risk. Now, if somebody sues, breaks their leg and sues you for whatever reason, and you're not covered by whatever insurance you have, or you don't have insurance or whatever it is, all of those properties are liable. That entire company is under threat. And it's the same with anything else, a mortgage default or anything else like that. When each property is ring-fenced in its own entity from each other, they're basically legally ring-fenced from each other. So something happening to one doesn't have a knock-on effect to that. Okay. The third reason we do it comes down to mortgage financing. So often lenders actually prefer them when they're in separate entities. The reason being is lenders, similar to that second point, are lending based on risk. So they want to know, well, are we going to get our money back from this? And so when you've got a property holding company with 10 properties in, all with different mortgages, all different things going on, there's a load of liabilities in there for the lender. And so they look at that and think, that's a bit more of a risky lend for me. Whereas when there's one asset in each company, there's no associated liabilities or other assets within that company, it's a much safer lend. And so you increase your mortgage lending options, and sometimes you access better rates and things like that. Okay. And so that's something definitely worth considering. And then there's sort of 3 or 4 other elements as well that I'll definitely kind of, I'll send you some information after, you can kind of send out to people as well. But there's, I think, 6 or 7 reasons in total we do it. And it's essentially the best way to learn.
No, that's interesting. And from an equity release standpoint, can you release equity from these properties if it's held in a company or in an SPV? Is that still possible? It's the same as, you know, if it was held individually, it's no issue.
Refinance. Yeah. Limited company mortgages are a bit of a lie. Well, they're not a lie per se, but they're not quite as complex as people make out. So they're pretty much the same as personal loan mortgages. And the reason being is that the lender isn't generally looking at the company. They're looking at what are called the UBOs. That's who's behind the company. So the ultimate beneficial owners. So they're looking at the shareholders and the directors. They're going to credit check them. They're going to look at their income levels, and they're going to look at them from an AML perspective and things like that. And so akin to a personal name mortgage where you can refinance, it's the same limited company. You can refinance. Obviously it's determined by kind of the length of the mortgage you're on and the kind of conditions of it. But yes, you can very much do.
That's interesting. I think that's this is all, you know, half of this is very new to me and something that there's not many people, you don't see many people really promoting it in the open market at the moment, unless it's like the groups you mentioned in the past, charging $2.5 or close to $2,000 for fees.
And I think people are scared of it. People don't really want to get into the nitty gritty of it, and even accountants typically are quite old school. You know, there's a very kind of common mantra in the UK, I think, of people going to that high street accountant. And I think it's because it feels safe, but it's not usually very efficient or very effective, because they're very old school in their thinking, and things can be very slow and be very expensive. And so what we're trying to do is give, you know, real high level understanding of investment structuring to people, make it really accessible and hassle-free, and then make it really cost-effective as well.
Okay, no, that's it's good. I think, you know, with technology and the way in which things are changing at the moment, we're both in that prop tech world. You could say we both work for prop tech businesses, and I think that it's evolving now. We're seeing a transformation in the technology world, and the combination with property and businesses like yourself, businesses like Wealthy, creating platforms where it makes the process so much easier for our clients to understand. And like you touched on at the start, that educational tool, we do these podcasts to help educate our clients on things that are changing and products that are available, like GetGround's offering, and trying to make that process as easy as possible for them. We're trying to be as transparent as possible. And I think there's more and more businesses that are making that process as easy as possible. And I think, like you touched on with, you know, you go to your high street lender, or you go to your high street real estate agent, or whoever it may be, and it's what you've kind of been embedded from a young age. Your parents would drag you down to the local real estate agency and you go look at houses or whatever it may be. And so in your head, you're thinking that's the traditional way of doing it. But now with technology and businesses that are adapting the way in which they work, it's the face-to-face value is losing a lot of what its power from what it once has, I feel.
I still do think it's very much important, and it's why we are a tech company with a physical face. So they're not speaking to robots, you know, or anything like that. You know, they're not dealing with automated systems. You know, they're dealing with a consultant, and then they're dealing with our operations team, and then everybody else. And I think it's important to maintain that. But you know, as you say, in years gone by. So if you're investing in stocks and shares in the past, you would call your local stockbroker or your preferred stockbroker, and he would give his take on things. Now, his take might be good, but it also might be bad. But his take is nowhere near as good as what, you know, really embedded technology that assesses all financial markets can give you. And that's what people have now. It's why, you know, stockbrokers in the conventional sense of what they were in the past either don't exist anymore or are in a very different role. You know, whereas the same with properties. So, you know, so I think something people mistake with accountants as well is assume they're experts in everything. Most accountants are generalists, and that's not necessarily a bad thing. Accountants are fantastic at what they do, and we have our own accountants and things like that. But you know, property specific accountants are much harder to find and can be much more expensive. And even when you do find them, they can also be very set in their ways. So, for example, owning in separate entities would be very hard for a traditional accountancy firm to promote, because it'd be extremely expensive for the client, because you'd be replicating that £1,800 a year for each company. And they don't have the tech or the software to do it easily and manage all that. And so if somebody came through with 10 companies, that'd be a nightmare for them. That's a huge amount of time. Whereas for us, that's not a problem at all. That's where
couple clicks, 20 minutes later, and you're set up, you're ready to go. I like it. It's a very good proposition. Now, in terms of the market, again, we'll go back to this point and get your predictions on what you can see happening in the next 12 to 24 months. I'm interested to hear your take on it at the moment.
Yeah, I mean, the last 10 years or so has been London, London, London. And everybody's obsessed with London, and it always has been. People have always flung money at London. But I mean, I'm sure you yourself know, it is unfathomably expensive in London. It is just off the wall expensive. I think the average property price in London at the moment is something like £500,000, which is just crazy. It's crazy. And it's got to the point where even international investors, which used to be the people who propped up the London market and in a way made it so expensive, even they are struggling to afford in London right now. And so, you're talking £900,000 for a fancy 2-bed in Battersea, which is crazy. Yeah, exactly that. So from an investor perspective, you're seeing people naturally out of necessity being forced to other parts. So you're seeing a lot of activity up north, especially in the northwest, but definitely in the northeast too. So my hometown of Liverpool is kind of the hot topic the last year or two, and will be probably for a few more years. I'm trying to convince my parents every week to buy more property up there. But I think it's not even just out of necessity. I think COVID's been really interesting because during COVID, I don't know if you're the same, but London got a bit scary. We didn't know what was going to happen. And I thought, well, if things are going to get really bad, I'm going to go home to my family home in Liverpool because I'd rather essentially get sick in Liverpool at the time because it was very small. But it was a small place. I thought maybe you're getting to hospitals more, whatever. But anyway, I spent about a year and maybe 3 months living and working back in Liverpool. I basically fell in love with Liverpool again and realized what a wonderful city it was, how affordable it was, how well connected it was to London, because I was still going up all the time. It's 2 hours on a train, and quite an affordable train into Euston from Lime Street. And I realized, London's great, but it's unlivable in the future. I want to live in a really nice city where I can afford things, where it's green, where it's got wonderful atmosphere and nightlife and culture and things like that. And that's what a lot of the UK regional cities have. So a lot of people internationally might not have heard of them, but places like Birmingham, Bristol, Liverpool, Manchester, Sheffield, Leeds, Newcastle are tremendous cities in their own right. And I think what you're going to have is a real pattern of just an exodus from London. I managed to work in the exact same manner that I do in person in London from 250 miles away for a year and a half. And everybody's kind of realized, hang about, people used to come to London because that's where the jobs were. And now they've realized, well, hang about, we don't need to be in London for the jobs. And you used to have your old cohort who were sort of 35 plus, who were like, people 35 and beyond would start to leave London. They'd set their families up elsewhere. What I'm seeing myself now, so I'm only 25, but what I'm seeing now is my friends who are of equal age saying, okay, I'm done with London. I'm going to Manchester. I'm going to Liverpool, Newcastle. I'm going to Birmingham. And companies are following suit. So Birmingham, for example, I think Goldman Sachs has just set up an office in Birmingham. We'd said 10 years ago, people would laugh at you.
Exactly.
I'll put its headquarters in Birmingham.
It's mental.
RBS have a headquarters in Birmingham, and it's Manchester the same, and business is starting to flow that way as well. And, the transport networks in the UK are interesting as well. And for any kind of foreign buyers watching, the UK is very small, and it's kind of a benefit to it because it means it's really accessible. So even if you're in Liverpool, which on a map looks like a long way away from London, actually physically in the UK, I think it's 1 hour 57 from Lime Street to London, which is a very easy commute to do, once, maybe twice a week. And I think that's what the working model will become, especially for a lot of professionals, to do 3 days a week from home. And then 2 days from London, up and down the country, and take flies to Manchester and places like that. And so I think with an exodus of people from London to Birmingham, Liverpool, Manchester, Bristol, wherever it might be, those cities are just going to take off even more. I think capital gains will be brilliant there, but I think rental yields will be great there because the more professionals you have, not basing themselves in London and basing themselves in places like Manchester, Birmingham, wherever it is, they can afford higher rents, and so rental yields will increase in those places as well. So that's my take, at least.
No, I agree. And there was a stat I saw yesterday, actually, when I was doing a bit of digging into Birmingham. And apparently 300,000 people have migrated to Birmingham in the last decade. So in the last 10 years, 300,000 people have moved up to Birmingham. And you named, Goldman Sachs, that had moved up there. You've got Deutsche Bank up there as well. HSBC had moved the headquarters up there. in my head at the moment, I see Birmingham as a fantastic opportunity. I think it's once HS2 is finished, you're 45 minutes to get into central London, into Euston Street. It's nothing. So I think that I can see Birmingham really becoming a commuter city in the next, let's say, 3, 4, 5 years, really once everything's in
I would argue
stone.
it already is the truth. I would argue it already is. So I've had to do some work up in Birmingham, and I was mind blown about how quick it was to get there, as you say. And Birmingham as well. Birmingham's a funny one because I don't think people are quite, a lot of people, especially internationally, have never even heard of it. Birmingham's actually the UK's second city. It's the second biggest city in the UK. I forget what the actual population volume is there, but
it's like 1.1 mil now or something. It's incredible.
I think that might just be the central area. I think beyond it, my understanding was it was kind of closer to 2 to 3 million.
Wow.
In terms of the kind of total kind of conurbations of it heading out into the Midlands there. And it's I think Birmingham's a bit like Liverpool as well. So Birmingham and Liverpool in the past had fairly negative stereotypes attached. They weren't seen as the most attractive places to be. They're industrial towns. They're working cities.
Yeah, working cities.
Exactly. They're working cities. In the Industrial Revolution, they were until relatively recently, and they were traditionally quite poor cities. But Liverpool and Birmingham, especially, and probably Newcastle to a degree, have really shaken off that over the last few years and have become these kind of cultural centres and a focal point for young people, which is always a good thing. I mean, the more young people who decide to stick around in a place and build things and build an environment they actually want to be in off the back of that has wonderful repercussions from. And Liverpool's been like that. It's become an entertainment city. Birmingham's becoming more like that. You know, every time I go up to Birmingham, I'm like, oh, it's actually really nice here. I didn't expect it to be at all. You know, British people love their stereoteries and, you know, assuming how things are going. Actually, the reality, it's why you should never trust in a stereotype because
no, I agree.
The minute you go to a place, you get a completely different take on it.
No, it's everything. These cities are changing at the moment. They're evolving, and I think we soon give it another 12, 24 months. Maybe there'll be another city. You mentioned a couple: Sheffield, Newcastle, Preston. Even they'll start to receive even more funding from government grants and infrastructure projects to be put into these cities. But time will tell with those ones. But I'm keeping a very close eye on Newcastle. I think that's an opportunity at the moment.
I agree completely as well. And especially, you know, so Newcastle's not very far to Edinburgh. And Edinburgh as a business kind of focal point is growing rapidly as well. I mean, there are already significant kind of business opportunities and business operations up there, as well as kind of, you know, universities and things like that. And it's commutable. And as these, you know, train networks, HS2, HS3 get better and better, and the UK becomes even smaller. So it's already small with kind of what people would often complain about is not great train lines. You know, imagine what it would be like when actually those, you know, come into play and how I think we'll have a very different living situation in the UK. People will be living a lot further from where they work and commuting in a much shorter time, essentially.
Cool. No, that's good. Good little roundup there. I like that. I think there's a lot of optimism on the horizon for the UK in terms of property prices. But the last question, and what I like to finish up with all of my guests, is more of a general question around what does a wealthy life mean to you?
Wealthy life? Oh, God. Billions and billions and billions of pounds.
Be nice.
Certainly not. I mean, it's probably fairly cliche, but I suppose it's a balanced life. It's, you know, wealth not just in terms of, you know, what's in your bank account, but you know your contentness, your physical health, your overall happiness is probably a good gauge of that. But your financial investments often, I mean, people always talk about, you know, and say, oh, money's not everything, and it's certainly true, but playing with your money in the right way and putting it into the right things allows that life, is the point. It allows freedom. I think freedom is probably the big part. Again, it's a very cliche term.
I completely agree then. It's being able to enjoy the things you want to do in life, essentially.
Precisely. And cliches exist for a reason. And property as a whole, I mean, it's fascinating. It's the only asset class that gives you basically a lifestyle you can live off. So as good as stocks and shares might be, and as wonderful as the returns might be, you know, unless you have vast numbers of shares, you can't really live off dividend income. You know, you can in terms of rental yield. I mean, and many people do live off rental yield, and it doesn't take as many properties as you think to do it. And once you get into a position where, you know, the yield from your rental properties is paying your mortgage, I think that's always a very common goal for people. I think it's a wonderful place to be at. And so, and it's not particularly unachievable. Property as an asset class is great as well because it's understandable. People are often put off by investing in general because it seems complex. It seems scary. So there's numbers going everywhere. We don't know how companies operate, and we don't know how value goes up and down. And investing is for rich people. Well, actually, it's for everyone. And it's property is very tangible. People understand how a property works.
Yeah.
You buy a property,
you go touch it.
You don't push it. You get property. You get all people to do the work for you, including us. You hold it in that, and you get paid every month essentially. And the value of that asset increases over time. Yeah. If you want to increase it even more, you can add an extension, or you can do this, or you can do that. And it's a really interesting class. And I think, it's definitely part of my wealth plans, put it that way. I'm obviously biased in the industry, but it is true. And there's always, again, it's not a cliche line, but you hear things banded around the place, like 80% of millionaires are millionaires through property investments, be they commercial or residential. And so I don't know how accurate those figures are, but the general point is, it has resulted in a lot of people.
Yeah.
Well.
That's good. I like it.
And it's, I think the final point I would make about the UK as well is, I think the UK is turning into a much similar setup to a lot of European countries. So in Germany, for example, the vast majority of people don't own their own homes. They rent, and they rent for their entire lifespan. Now, some people take a negative approach to that and say that's not good. We want to own our homes and things like that. But the quality of life in Germany is pretty wonderful. And they have a very nice standard of living. And it's the way it's done that most people don't own their property. They rent it forever, and they have rent controls and things like that. And a very high quality of living. And I think the UK is going the same way as a lot of European countries are in that regard, and becoming a much more of a renters economy. And it's a great position for potential landlords to get in on early, essentially.
Exactly. Get in now. Take advantage of that opportunity. Definitely. I'm looking to do it at the moment. So I'm sure you and I will be having some dealings very soon. But thank you very much for joining me on the show today. It's been fantastic to have a chat. And for anyone listening anywhere in the world, really, please feel free to reach out to myself or Liam, and more than happy to help on both ends from an investment standpoint, and helping you find the property that you're looking to acquire, and then pass you on to Liam, who'll be able to help structure that in an effective manner, essentially. So thank you very much.
Just a final point there. I think I mentioned it briefly before. If anybody watching does want a consultation or to understand what a limited company is, how it can be beneficial for their situation, etc., everything's completely free. So please reach out to Chris or myself, and we can get something set up with one of the consultants at a time that suits you.
That'd be fantastic. Thank you, everyone who's tuned in today. Don't forget to like, comment, and subscribe, and we'll be back next week with another episode. But thank you again, Liam, and it's been a pleasure talking to you.
Thank you very much for your time, Chris. Appreciate it.
Right.